All right, on part 3, we're going to continue to look at the second method, which is the aging of accounts receivable method to estimate bad debt expense. As we mentioned before, this is often called the balance sheet method because we're looking at from the perspective of accounts receivable, which is a balance sheet account. But this method, compared with the other method, remember percentage of credit sales method, it's a little bit more complicated, but the benefit is that this method is more accurate in estimating bad debt expense. But it does comes with its cost, that is, it's slightly more complicated to estimate, and then from the accounting journal recording perspective, a little bit more complicated than the percentage of credit sales method. Okay, so as the name suggests, this method look at the age or how long the account receivable have been outstanding, and then give different estimate percentage to different accounts receivables of different ages. So the idea is the more recent account receivable or younger account receivable is less likely to go bad and become uncollectible. On the other hand, the older and more overdue account receivable, and then the probability of it become bad debt or uncollectible is obviously higher. So that's the premise, that's the understanding. To apply the aging of accounts receivable method, we're going to take 3 steps. First, we're going to prepare an age list of accounts receivable. And second, we're going to estimate bad debt loss percentage for each age category. And third, we do the calculation, and then to calculate and to compute the total estimated bad debts. Okay, there is a caveat there, but we're going to look at we cannot directly write that or record that in a journal entry. We have to figure the journal entry number out, but we're going to see. So let's look at the same company, BFC's account receivable. We have a table that analyzes the account receivable by different accounts, right? We have A, Adams, Momentum, others, Zoom, 4 different categories of customers. And the most important part is here. We look at the number of dates those accounts are unpaid. So basically we divide them into 1 month, 2 months, 3 months, and over 3 months. So for example, for Adams Sports, we have $400 in the 1 month or 0 to 30 days category, $200 in the 2 month, and $100 in the 3 month category. And we do the same for the other 3 customers, and then we add them up together. The second step. So we analyze or categorize all the accounts receivable from the 4 different customers along or by how long they have been unpaid or outstanding. So we realize, okay, we have a total accounts receivable of $120,000 in the first category, which is less than 1 month or 0 to 30 days. We have $45,000 in the second category, 31 to 60 days. We have $37,000 in the third category, 61 to 90 days, and then $6,000 accounts receivable in the last category over 90 days. So that's the first step. And the second step, we estimate the percentage of accounts receivable that will eventually become uncollectible as time goes by. Because of the principle we mentioned early on, that the younger the account receivable is, the less likely they're going to turn bad. And then the older the account receivable is, the higher the possibility that they will become uncollectible. So we give a 1% estimate for 0 to 30 days, 10% to 31 to 60, 20% to 61 to 90, and 40% to over 90 days. Alright, and then I think you can guess what I'm going to do next step. That is, we calculate the estimated uncollectible accounts receivable of each category. So $120,000 of 0 to 30 day category, 1%, so that's $1,200. 45,000, 10%, that's $4,500. $37,000, 20%, that's $7,400. 6,000, 40%, that's $2,400. So, and we add those four numbers together. 1,200, 4,500, 7,400, 2,400. You add the four numbers together, we get $15,500. That's the total estimated uncollectible accounts receivable. So here, the method is done. We find out that the target estimated uncollectible accounts receivable amount is $15,500. So let's look at how do we do that from a journal entry perspective, or how do we use that information. So here, I think this should be very familiar to us. It's a T account, right? We have the allowance for doubtful accounts, T account, which is a contra asset account. So increase goes on credit side, goes on right hand side. So the unadjusted balance, or before we do the end of the period adjustment, we already have a balance of $14,200 in this account, credit balance. And then we just calculated that the desired balance, or the target balance of unestimated collectible accounts is $15,500. So before the adjustment, we have $14,200 in credit balance. After the adjustment, our goal is to achieve or arrive at $15,500 in desired balance. So what's the adjustment journal entry we have to make here? $14,200 plus $800, plus $1,300, equals $15,500, or $15,500 minus $14,200 give you $1,300. So we need to make an adjustment journal entry of $1,300. Adjustment journal entry of $1,400 comes from $15,500 minus $14,200. So we can prepare the journal entry here. Debit, bad debt expense, $1,300. Credit, allowance for doubtful accounts, $1,300. To summarize them in T accounts, for the allowance for doubtful accounts, T account, before the adjustment we have $14,200. We increase that by $1,300. We arrive at the target, which is $15,500 in allowance for doubtful accounts. We look at our bad debt expense at the beginning, which is also the ending balance of January, the beginning balance of February. We have $900. It's an expense account, so increase goes on debit side, goes on left. We add the adjustment journal entry of $1,300, so the ending balance for bad debt expense as of the end of February is $2,200. Some other issues, sometimes we have to revise our estimates. Bad debt estimates always differ from the amount that later written off. That's why it's by definition an estimate. If those differences are material, companies are required to revise their bad debt estimates for the current period. So that this is also an area sometimes managers can be optimistic and hide some revenues, hide some sales revenue in their allowance account, and kind of for the rainy days. So when revenue, for example, next period decline or doesn't grow as much as they hope for, they can use some of the previous revenue that they have hidden in the allowance account. But that's a different topic. One more issue that I'm going to talk in this clip of video of my lecturing is accounts recovery. So which refers to collection of a previously written off account. That's called a recovery, and it's accounted for in two parts. First, is put the receivable back on the book by recording the opposite of the write-off. Remember, in the write-off we said what? Yes, debit allowance for doubtful accounts, credit accounts receivable. So we're going to reverse that. And second, we're going to record and recognize the collection of the cash payment of the account. So let's see. Let's say VFC collected the $800 from fast fashion that it was previously written off, remember, in January, in February. So the recovery would be recorded with the following two journal entries. First, we reverse the written off. So we do the opposite of the written off journal entry. So we say debit, account receivable, $800, credit, allowance for doubtful accounts, $800. And second, we recognize the receiving of the cash payment. Debit, cash, $800, credit, accounts receivable, $800. You may notice that the journal entries here only affect what? Only affect the balance sheet. It does not affect the income statement. And then if we notice that the debit and credit of the account receivable kind of cancel each other out, and we recognize cash, we basically put some of the money back into the allowance account. And just as we mentioned before, because the net accounts receivable after allowance is the difference between account receivable and the allowance account. As a result, if you increase them both by $800, guess what? The net accounts receivable amount remains the same. So again, because the net accounts receivable is the difference between accounts receivable and the allowance account. As a result, if allowance and account receivable both increase the same amount or both decrease by the same amount, the net accounts receivable remain the same. Okay, so let's stop here for this clip.